Over the past 15 years, I've made millions of dollars for myself and millions of dollars for my clients investing in financial markets. In the next 10 minutes, I'm going to give you the number one piece of advice I learned the hard way, and it could save you from making the most expensive mistake of your investing career. Now, for those of you who do not know who I am, my name is Stephen Brooks. I'm a hedge fund manager who specializes in systematic option strategies, primarily on the S&P 500. Now, I do have to preface this. This video is not for the buy and hold audience. If you're someone who buys an index fund or an ETF or a stock and wants to hold on to it for many, many years, this specifically is not for you, right? You're at the mercy of whatever the market does with no ability to change that. So if you are a long-term buy and hold investor, this video will not be helpful for you. The type of person this is going to be incredibly beneficial for, and potentially the best video you've ever watched in your life, is someone running active strategies with the goal of cash flow. For example, in our fund, which has outperformed the market by 22% over the past 6 months, we place anywhere from 20 to 100 different intraday trades in the S&P 500 every day. And we are in cash overnight. Every single day when the market is closed, we have exited all of our positions. So this video is for those kind of people. Now, the number one piece of advice I could ever give you is this. Every single strategy you add to your portfolio needs to be sized based on the potential drawdown. The problem that most people run into is that they see the potential for huge upside numbers from any individual component of the portfolio. 15% return, 20% return, 25% return, just from a single component of the model. And they see that and they think, my God, that's going to be amazing. But the reality is, it is only going to be amazing if you can handle the drawdowns that are required to get the upside that you're looking for. Now, in most cases, I have not seen an effective strategy that stands the test of time with a MAR ratio of more than 3. Now, what does that mean? The MAR ratio is the compounded annual growth rate, or your annual return, divided by the maximum drawdown during that period. So over the past 5 years, if you made 10% per year, but during that period, there was a single instance of a 5% drawdown, that would be a 2 MAR ratio. When we're looking to add components to our portfolio, we're looking for a 3 MAR ratio or better. So if we're making 9% on the upside for an individual component of the portfolio, we want the maximum drawdown during the model period to be no more than 3%. So what we do is we make sure each individual component of the portfolio, each strategy, is modeled with a maximum drawdown of 2% or less. I'm going to repeat that. We make sure every single individual component of the portfolio is modeled for a maximum drawdown of 2% or less. Meaning, if we have one of these individual components in the portfolio and each of them carries a 3 MAR ratio, then our expected upside for each strategy is only 6%. Now, you might be saying, well, Stephen, how are you going to make more than 6% if every single strategy in your portfolio is only modeled for potential upside of 6%? Remember, all of these components of the portfolio are uncorrelated to one another. And that's the most important thing if you watch any of my other content, is that the individual components of the portfolio should be uncorrelated to one another, meaning the result from strategy A should be close to completely random compared to the results of strategy B. So here's what actually ends up happening when you do this. When you take strategy A, which has, let's say, a 3 MAR ratio, means a maximum drawdown of 2%, and we add in 7 other strategies. Because they are not correlated to one another, you end up with a maximum drawdown at the portfolio level that stays well within your model, while the upside potential are all added together. So from a personal standpoint, over the last 6 trading sessions, we've experienced 6 consecutive losing days. Now, that is pretty rare that would happen to us. Of course, it's also quite rare that the biggest commodity in the world, oil, is trading like GameStop. But it's very rare for us. We've modeled everything so accurately that the drawdown on our portfolio after 6 straight losing days is not even 2%. And the reason that matters so much is because the upside that you see, right? The upside that you want, which we're able to generate, is something when we only have a 2% drawdown after a pretty bad scenario. The upside that we want is something that is very realistic. Why? Because our drawdowns are emotionally very, very manageable. Now, in my experience, it is different for everyone. Some people can't handle losing money at all. Some people are way more comfortable being down a big number. We're dealing with client money, and most of our clients have no risk appetite whatsoever. So we want to make sure that we're modeling the drawdown level to something that people are very comfortable to. Now 2%, it's a very tight number. And there's going to be times where we go outside of that because our models, they're just models, right? They're not predictors of the future. So there's going to be occasions where we exceed that projected drawdown, no doubt. But what would be unlikely is that we go, 3 times outside of that, 4 times outside of that, even if we go 2 times outside of that for what is modeled. That is still a level where everyone involved is incredibly comfortable from an emotional standpoint. And because of that, we continue to execute the strategies exactly as designed every single day. We never feel like we got punched in the mouth. And the upside, which is what we're going after, becomes something that is very attainable and very achievable because we have been able to keep our emotions in check. They were able to follow the model every single day, rain or shine, no matter what. So if you operate kind of in my world, multiple individual components, systemized strategies assembled into a portfolio with the goal of producing cash flow in an uncorrelated way, the absolute best thing you can do at the individual component level is actually try to make less money. Try to target a much smaller return, because by having a goal of a much smaller return at the individual component level, the portfolio is able to experience drawdowns that in the overwhelming majority of cases will be in line with what you are emotionally comfortable with, and thus the upside, which is the goal, because something that is actually achievable. Now, I have seen this time and time again. Investors block themselves from being able to experience any semblance of upside because the models they are following, whether they're following a model or not, and the position sizes that they take carry drawdowns that are actually way too big for them. They think they can handle a 10, 20% drawdown, but in reality, they can't. So the single best piece of advice I could give you is this. When you are modeling an individual strategy as a component of your portfolio, the drawdown is the single most important number, and the size you take on with that trade needs to be modeled around a drawdown level that allows you to continue to execute the strategy even during its worst period, so that there is actually a realistic chance you get to experience that upside. So this is exactly what we do in our fund. Every strategy that we model is sized every single day based on a 2% maximum drawdown. And as you see right here, when you combine them, the drawdown at the portfolio level is spread out, but the upside is added together. Now, here's what's really fascinating. What you're seeing at the bottom of the screen is the model. Here are the results we have experienced over the past 6 months, very much in line with what the model suggests over that same type of period. So if you are interested in investing in a fund that is actively doing this, you will need to be accredited. There will be a link below this video that you can go ahead and click on to learn more. And if you're not yet accredited, but also want to learn how to do this yourself and utilize our software to automatically place these trades in your own account, there will also be a link below this video where you can check it out as well.